In the last 36 months, 1.2 billion ounces vanished from the global system. No headlines, no emergency meetings, no warnings, just withdrawal. The institutions that monitor these vaults, the ones who are supposed to sound alarms when critical thresholds are breached, have gone completely silent. And that silence, that's the part you need to understand. Right now, at this exact moment, you are witnessing the largest physical commodity drain in modern financial history. And it's not slowing down, it's accelerating. Major vaults spanning 3 continents, London, New York, Shanghai, are hemorrhaging silver at rates that would have triggered containment protocols in any other era. Emergency measures, regulatory freezes, something, but there are no protocols this time. The futures market continues operating as if nothing has changed. Price discovery moves normally. Financial media directs your attention toward tech earnings and inflation data. Meanwhile, physical silver is draining from the registered vaults that serve as the foundation, the literal bedrock beneath the entire paper market. And when you truly understand what registered means in this context, you'll recognize why this qualifies as a silent emergency. Here's the mechanism most people never see. Silver doesn't trade in one market. It trades in 2 parallel dimensions that are supposed to mirror each other, but increasingly don't. There's the paper dimension, where hundreds of millions of ounces move through futures contracts, exchange-traded funds, and derivatives every single day. This universe is vast, liquid, built on leverage and velocity. Then there's the physical dimension, where actual bars, actual metal, changes hands. This universe is small, finite, constrained by geology, mining capacity, and vault space. The entire architecture of modern silver markets depends on these 2 dimensions staying connected. The paper claims are supposed to represent real metal. That's the contract, that's the foundation of price legitimacy. But that connection is fracturing, not loudly, not dramatically, just consistently, ounce by ounce, withdrawal by withdrawal. The physical universe is separating from its paper reflection. Let's descend into what these vaults actually are. When you hear terms like COMEX silver inventory or LBMA vaults, your mind might conjure images of Fort Knox, massive government reserves, strategic stockpiles managed with military precision and sovereign oversight. That image is wrong. These are commercial vaults, private warehouses holding metal that backs futures contracts, ETF shares, and allocated accounts for institutions and high net worth individuals. The silver sits there as physical proof, tangible evidence that paper claims have real substance. But the architecture is more fragile than most people realize. Silver inside these vaults exists in 2 states, registered and eligible. Registered silver is the metal actively pledged to back futures contracts. It's committed. It's the foundation layer that gives the paper market its claim to legitimacy. When a trader demands delivery on a contract, the metal must come from registered inventory. Eligible silver sits stored in the same vault but unpledged. Think of it as parked, available to shift into registered status if needed, but not currently supporting any contracts. Now watch what's happening to these numbers. Over the past 36 months, registered silver in the COMEX has collapsed by over 60%. The inventory dropped from roughly 400 million ounces to less than 160 million. That's not a correction. That's not market cyclicality. That's structural disintegration. And here's the part that should trigger alarm. Eligible inventory isn't offsetting this. Total vault holdings registered plus eligible combined have been falling simultaneously, which means the silver isn't just changing categories inside the vault system. It's leaving entirely. Where is it going? Some flows toward industrial consumption, that's expected. Silver is the most electrically conductive metal on Earth. Non-negotiable for electronics, solar infrastructure, electric vehicle components, medical devices. That demand is structural and growing. But industrial buyers typically source from refiners and mining operations, not investment vaults. The volume moving through these particular vaults suggests something different. What you're seeing is institutional extraction. Large asset managers are taking delivery and relocating metal into private storage outside the traditional banking system. Sovereign entities are quietly accumulating. Ultra-high net worth families are pulling allocated silver away from custodial arrangements entirely. They're removing it from the registered pool, the exact pool that underwrites the paper market's integrity. Think about the structural implications. Every ounce withdrawn from registered inventory weakens the foundation beneath billions of dollars in derivative exposure. The leverage ratio climbs. The system becomes more fragile. The gap between paper claims and deliverable metal widens. And unlike gold, where central banks collectively hold roughly 22% of all above-ground supply and can intervene during crises, central banks hold essentially zero silver. There is no strategic reserve, no lender of last resort, no institution capable of flooding the market with supply to stabilize a panic. The vaults are the only backstop, and the vaults are draining. This dynamic has historical echoes that are impossible to ignore. In 1980, the Hunt brothers orchestrated one of the most aggressive commodity corners in modern history. They accumulated over 200 million ounces of physical silver, systematically draining COMEX inventories and driving prices toward $50 per ounce. The exchange responded by rewriting the rules mid-crisis. They implemented liquidation-only trading policies, preventing new long positions while allowing shorts to cover. The Hunts, leveraged to the breaking point, were forced into catastrophic liquidation. Prices collapsed, fortunes evaporated, the corner was broken. But here's the crucial difference between 1980 and today. The Hunt brothers were two identifiable billionaires using massive leverage and borrowed capital. Regulators could target them specifically. The moment their position shattered, the pressure released. Today's vault drain isn't coming from two brothers in Texas. It's distributed across thousands of buyers spanning multiple continents, institutions, family offices, sovereign funds, private individuals. There's no concentrated position to unwind, no single entity to pressure. And critically, these buyers aren't leveraged. They're paying cash and taking possession. You can't margin call someone who owns their metal outright. There's another parallel worth examining from a different angle. In the early 2000s, the London bullion market faced a structural fracture with gold. LBMA member banks had issued paper gold claims that vastly exceeded their physical reserves, operating on the assumption that redemption requests would remain modest and manageable. Then 2011 arrived. Gold prices surged. Redemption demand spiked. Several major banks faced the genuine prospect of defaulting on their obligations. The crisis was contained through backroom negotiations and coordinated price suppression efforts, but it exposed the leverage illusion. The system had been operating on borrowed confidence. Silver is following an identical script, except the ratio of paper claims to physical availability is exponentially more extreme. Here's why this trajectory may be irreversible. Global silver mining production has plateaued. Despite higher prices and intensified exploration, total mine output has barely increased over the past decade. The richest, most accessible deposits have already been exploited. Developing new mines requires 7 to 10 years minimum from discovery through permitting, construction, and production. Even if mining companies launched aggressive exploration campaigns today, new supply wouldn't reach markets until the early 2030s. Meanwhile, industrial demand is accelerating along multiple vectors simultaneously. Solar panel installations are expanding exponentially as nations race toward renewable energy targets. Each panel consumes roughly 1/3 of an ounce. Global solar capacity is projected to triple by decade's end. Electric vehicle production is ramping under regulatory mandates. Each EV requires approximately 1 ounce of silver. Annual production is expected to quadruple from current levels. AI infrastructure demands massive data centers packed with silver-intensive components, advanced chips, high-current connectors, precision cooling systems. This isn't speculative demand that evaporates during recessions. This is structural consumption embedded in the global technological and energy transition. The math is straightforward. Rising industrial consumption plus stagnant mining output plus ongoing investment demand equals deficit. And the silver market has been running a structural supply deficit for consecutive years. That deficit gets filled by drawing down above-ground stockpiles, existing inventory, vault withdrawals. But here's the terminal problem with inventory-based supply. Eventually the inventory depletes. And unlike oil, where governments maintain strategic petroleum reserves that can be released during emergencies, there is no strategic silver reserve, no government stockpile, no central bank holdings. The commercial vaults are the buffer, the shock absorber, and that buffer is contracting. So what does this mean for your financial reality? If you currently hold silver exposure through ETFs or futures-backed investment products, you're holding a claim on metal that may not physically exist when you attempt redemption. Read the prospectus carefully. Most silver ETFs explicitly reserve the right to settle redemptions in cash rather than physical delivery under certain market conditions. The legal language protects the fund structure, not your interests. If vault drainage accelerates into genuine shortage, those paper claims could be forcibly settled at administratively determined prices, potentially far below what physical metal trades for in private transactions outside the institutional system. We've observed this dynamic in other commodity markets. During the 2022 nickel crisis, the London Metal Exchange unilaterally canceled billions in executed trades and imposed artificial settlement prices to prevent clearinghouse defaults. Traders who had positioned correctly saw their gains erased through regulatory intervention. The system protects its own survival. Retail participants are expendable. Now consider the inflation protection angle. One of the primary rationales for holding precious metals is preserving purchasing power during currency debasement. But if your silver position is a paper derivative that can be cash settled, you're not actually holding a hard asset. You're holding a contractual claim on a hard asset. And contractual claims fail precisely when you need them most, during systemic stress. There's also a portfolio construction dimension that affects long-term planning. If you're depending on precious metals as a defensive allocation, something that provides stability when equities and bonds correlate downward, the difference between owning physical and owning paper could determine whether that allocation actually functions during the crisis it was designed for. Historical analysis shows that during monetary instability, physical assets decouple from their paper proxies. The premium for taking delivery explodes. Availability vanishes. By the time that separation becomes obvious, conversion is no longer possible. So what are the informed institutions doing with this information? They're quietly taking delivery. Major asset management firms, multi-generational family offices, and sovereign wealth entities have been methodically withdrawing metal from COMEX and LBMA vaults, relocating it into private storage facilities outside the traditional banking infrastructure. This isn't speculation. The data is public, published in exchange inventory reports. You can track the withdrawals monthly. What you're observing is a silent vote of no confidence. These institutions are positioning for a scenario where physical availability matters more than paper price. They're not speculating on silver appreciation. They're hedging against a future where the paper market's delivery mechanism fails under stress. Notice also the expansion in private vault infrastructure. Specialized precious metal storage facilities have proliferated significantly over the past 5 years, concentrated in Switzerland, Singapore, and select U.S. jurisdictions. Why would vault capacity be expanding if demand for physical storage were declining? It's not declining. Vault construction reflects a structural shift toward private, allocated, segregated holdings outside institutional custody. Then observe industrial stockpiling behavior. Major corporations in solar manufacturing, electronics production, and defense contracting have begun building strategic silver inventories rather than relying on just-in-time supply chains. They're accepting carrying costs because they've calculated that future supply uncertainty represents greater risk. When large industrial corporations start behaving like survivalists, the signal matters. Let's map what the next 12 to 18 months might bring. If current withdrawal velocity continues, COMEX registered inventory could fall below 100 million ounces within that time frame. At those levels, the exchange faces a binary choice. Option 1, allow natural price discovery, let delivery demand push prices toward equilibrium wherever that equilibrium lands. This could mean exponential price increases, potentially orders of magnitude above current levels. Option 2, implement emergency rule changes. Restrict delivery, mandate cash settlement, protect the clearing system by sacrificing contract sanctity. Both paths carry systemic consequences. A parabolic price spike benefits physical holders, but destabilizes the broader derivatives complex. Financial institutions carrying short exposure face catastrophic margin requirements. Leveraged funds implode. Credit chains fracture. Rule changes preserve institutional infrastructure, but annihilate confidence in paper silver as a legitimate proxy for physical metal. Investment capital flees ETFs. The price of paper and physical diverges permanently. Either way, the current equilibrium where paper and physical trade at functional parity cannot persist. There's also an escalating geopolitical layer. Silver is increasingly classified as a strategic resource due to its irreplaceable role in defense technology, renewable energy infrastructure, and advanced manufacturing. Nations controlling physical stockpiles gain leverage. Nations dependent on imports face vulnerability. We've already witnessed export restrictions and resource nationalism emerge in lithium, cobalt, rare earth elements. Silver could easily follow the same trajectory. If that happens, global markets fragment. Domestic and international price tiers diverge. Physical availability becomes restricted. Allocation becomes political. You'd witness a world where paper silver trades electronically and freely, but physical silver is rationed by governments. Here's the element that should genuinely unsettle you. The people managing these vault systems, exchange executives, regulatory officials, major bullion banks, they see the withdrawal data, they monitor registered inventory levels daily, they understand leverage ratios intimately. These are sophisticated institutions with quantitative risk teams and scenario planning departments, and they're saying nothing. No public warnings, no emergency consultations, no policy adjustments, which forces a stark choice between two interpretations. Either they genuinely believe the drainage will stabilize organically, that new supply or demand destruction will restore balance before the system reaches a breaking point, or they recognize it won't stabilize, and they're quietly positioning for managed failure, while retail participants remain entirely unaware. Consider the incentive structures. If you're a major financial institution carrying substantial short exposure to silver futures, you want the vault drain to remain quiet for as long as possible. Public awareness accelerates the crisis. Silence provides time to de-risk. If you're a government concerned about commodity-driven inflation, you don't want precious metals surging because it undermines fiat currency confidence. If you're an exchange operator, you don't want to trigger a delivery crisis that exposes the leverage embedded in your clearing infrastructure. Every entity with institutional power has rational reasons to minimize this situation, but physical metal doesn't respond to incentives or narratives. The metal is leaving, and eventually, whether in 6 months or 18 months, physics overrides policy. So how should you process this information strategically? First, distinguish clearly between paper exposure and physical ownership. If your investment objective is speculating on price volatility, paper products offer liquidity and efficiency. But if your objective is wealth preservation or crisis insurance, physical metal serves an entirely different structural function. Physical silver carries zero counterparty risk. It cannot be diluted through monetary expansion. It cannot be compromised by cyber attack. It doesn't depend on exchange solvency, clearinghouse integrity, or custodian reliability. It simply exists. And in an era of increasingly complex, interconnected financial instruments, that simplicity carries inherent value. Second, assess liquidity requirements carefully. Physical metals lack the instant liquidity of electronic securities. You cannot liquidate at market price with a button click. Bid-ask spreads widen, particularly in smaller quantities, but that illiquidity is actually part of the value architecture. It enforces behavioral discipline. You need to structure holdings so you're never forced to liquidate physical metal during temporary volatility. Third, maintain diversification discipline. Silver should not constitute your entire portfolio. It should function as a strategic hedge within a broader allocation that includes income-generating assets, liquid reserves, and growth positions. The wealthiest investors don't concentrate entirely in any single asset class. They allocate based on risk-adjusted returns across time horizons. But within that allocation framework, the question becomes critical. Do you want your precious metals exposure to be a paper claim or a physical asset? That distinction matters more today than it did a decade ago. 1.2 billion ounces have vanished from the system, not through catastrophic collapse, not through regulatory seizure, just steady, methodical, relentless withdrawal. Registered inventory has fallen 60%. Industrial demand is accelerating, mining output remains flat, and the institutions tasked with monitoring systemic stability have chosen silence. You can interpret this as a normal commodity cycle. You can assume markets will self-correct organically. You can trust that paper claims will be honored when tested under stress. Or you can study the vault data and ask yourself one simple question: when the registered metal is gone, when the physical backing beneath the paper market has been withdrawn, what exactly are those derivative contracts secured by? Markets don't announce their breaking points. They don't send warnings. Sometimes they just drain in silence, ounce by ounce, withdrawal by withdrawal, until the day someone demands delivery and discovers there's nothing left to deliver.